Good afternoon, everyone. My name is Jim Schowalter, Commissioner of Minnesota Management and Budget. Happy to have you here. We're going to be going through the February forecast. With me today is Dr. Kalambokidis, our state economist, and Ahna Minge, our state budget director. We'll provide you information on the state's budget as well as monthly U.S. economic information from our consultants, IHS Markit. After our presentation and Q&A, Governor Walz will join us and take your questions. It works. This forecast today anticipates a $1.5 billion improvement in the forecast for this current biennium. Our budget situation is strong. We're seeing a significant share of the money already in the bank, and we're in much better position to handle risks. The February forecast is normally a pretty simple affair, a light update from the November forecast. However, in the last couple of years, we've seen a different pattern. With a number of changes and on risks out in the economy and in society, February forecast has seen its share of changes. We've seen, sometimes it's hard to even anticipate what's going to happen next month, much less next year. The update part of this forecast is good news. We see an additional $1.5 billion, largely one-time money, and that's a significant improvement. Combined changes from the last forecast bring our surplus to more than $9 billion. But the uncertainty has not stopped. Even as we put the final numbers together for this forecast, the news broke, the terrible news broke, of the Russian invasion of Ukraine. This news is also significant and could put a dent in the anticipated forecast improvement. It's a challenging time to issue a long-term forecast. Of course, that challenge is nothing compared to the fears and challenges of families, the Ukrainian families here in our community and abroad. Through news and social media, we're seeing the terror of war happen right as it happens. None of this was anticipated a month ago. A Russian invasion of Ukraine wasn't part of our national economists' national economic model, and it changes some things. You look at the oil prices anticipated in this forecast, they'll become higher. You look at markets and financial markets, they're going to be unsettled. That's why the discipline of issuing a forecast in February makes a lot of sense. With breaking news, it's much easier to see the disruption than it is to see the adjustments that go with it. As with COVID 2 years ago, the news can be so fresh, hard to see anything else. So we present the forecast today. We know a little bit more. We've updated what we can. We acknowledge that there's still some uncertainty. And we plan to monitor and share information as we get it. Of course, if we do encounter problems in the next 16 months, our budget outlook is strong, and we're in a much better place to start working. Looking at the fiscal 22 and 23 biennium, you'll see that we're anticipating a positive balance of $9.3 billion, up about $1.5 billion from November. Higher income, consumer spending, and corporate profits lead to this improved revenue forecast. While many of the changes are one-time in nature, we continue to see a structural balance going into the next biennium. Now, as always, our forecasts do include a degree of risk, and Dr. Kalambokidis will walk through some of those changes later in this presentation. On the numbers, you see the specific revenues and spending. We're anticipating now that revenues are going to top $57 billion, about $1.3 billion better than previous estimates. Our spending numbers are down somewhat, about $270 million lower because of slight changes in education and health and human services. The budget reserve numbers are the same. The budget reserve changes only happen in November based on current statute, so there are no changes there. The only change is $15 million, which is in the stadium reserve account associated with charitable gaming that goes and helps pay off the stadium debt. So that's the overview of where we're at with this forecast. I'm going to turn it over to Dr. Kalambokidis to walk us through the national economy, the state's economy, and how that drives our revenue outlook.
Thank you, Commissioner. Thank you, everyone, for being here today. Again, I'm Laura Kalambokidis, Minnesota State Economist. I'll start with the U.S. economic outlook and how it's changed since November. I'll move to talk some about Minnesota's economy and Minnesota's labor market, and then turn to details of our new revenue forecast. The U.S. economy continues to recover from the 2-month recession that was triggered by the outbreak of the COVID-19 pandemic in the spring of 2020. In December of 21, the U.S. unemployment rate fell to 3.9%. Total employment had recovered to 97.8% of the pre-pandemic jobs numbers, and unemployment benefit claims had receded to 2019 levels. Home values, financial asset values, and corporate profits have all risen. The economy is forecast to recover to pre-pandemic employment levels this year, and economic growth is forecast to continue. Nevertheless, as you heard from the Commissioner, significant challenges to the U.S. economic outlook remain. Inflation, supply chain disruptions, labor force participation, the path of the pandemic, and newly, Russia's invasion of Ukraine all pose risks to the economic forecast. In the first chart, we're showing the IHS forecast for annual growth in U.S. real GDP. The gray bars show IHS's November outlook, and the blue bars show their February forecast. IHS now estimates that U.S. real GDP grew 5.7% last year, faster than the 5.5% they assumed in the November outlook. In addition, the winter Omicron wave of COVID-19 dampened consumer spending on services, slowing growth at the beginning of this year. Consequently, IHS now forecasts real GDP to increase 3.7% in 22, down from 4.3% in their November outlook. Growth is then expected to further decelerate to 2.7% in 23, down from 2.9% in November. Similarly, the growth forecasts for 24 and 25 are each 0.1 of a percentage point lower than in November. The forecasts for some underlying important economic variables have been raised since November. Forecasts for nominal consumer spending, wage and salary income, and corporate profits, variables that include the effect of inflation and influence tax revenues, are all higher than in November. Price inflation exceeded expectations in 21 as demand recovered faster in some capacity-constrained sectors than supply could match. In December of 21, the consumer price index rose 7.1% over December of 20. This brought annual inflation to 4.7%, the highest annual reading since 1990, and above IHS's November forecast of 4.5%. Higher and more widespread inflation in 21 has raised expectations for price increases this year. For 22, IHS now forecasts 4.5% inflation compared with 3.3% in November. IHS continues to expect inflation to be eased by the gradual resolution of supply chain issues by increased labor force participation. They also assume that households and business owners are confident in the Fed's ability to control inflation with monetary policy. Consequently, IHS expects price increases to slow in the second half of this year, and they forecast CPI inflation of 1.9% in 23 and 2.1% annually in both 24 and 25. Note, however, that the current IHS outlook was prepared early in February and does not reflect risks to energy prices, agricultural commodity prices, overall price inflation, and financial market volatility arising from Russia's invasion of Ukraine and the related sanctions against Russia. In their February outlook, IHS expected the Federal Reserve to begin taking action to raise the federal funds rate, interest rate in March of this year. That's 1 year earlier than they assumed in November, in the November outlook. More persistent or higher inflation could lead to earlier Fed action on interest rates, which could result in slower economic growth than is assumed in this forecast. In this chart, the height of the bars shows annual growth in U.S. total wage and salary income. This value can increase if more people are working or if wages per worker are rising, or both, and it's nominal. This means it can be boosted by inflation. And again, this is the sum of all of the payrolls of all of the employers in the United States. It's not wages per worker, so it's not an hourly wage or an average wage, it's the total payrolls. IHS expects the tightening U.S. labor market, meaning low unemployment and a high demand for workers, to drive up wage and salary income. They now estimate that wage income grew 9.1% last year, above the 8% they forecast in November. They forecast an acceleration to 9.4% this year, up from their prior forecast of 7.9%, followed by a deceleration to 5.8% in 23. The forecast for wage and salary income growth has been revised downward, an average of 0.3 of a percentage point for the years 23 through 25. This chart shows levels or dollar values, not growth rates, but dollar values this time, of U.S. corporate profits, which continue to exceed expectations. The solid line shows IHS's February outlook, and the dashed line shows what they expected in November. Corporate profits, which are the main factor determining Minnesota's corporate tax revenues, were unexpectedly strong during the second half of 21, growing 36.9% over the whole year, and driving higher than expected corporate tax receipts so far in fiscal year 22. In this outlook, corporate profits are expected to exceed the November forecast through 2025. Moving to Minnesota's labor market, this chart shows the official unemployment rates for Minnesota, that's the dark line, and the US, which is the light line. You can see the sharp spikes in employment in 2020 when Minnesota's unemployment rate reached 11.3%. As of December 21, the state's unemployment rate fell to 3.1%, 0.9 of a percentage point below the US unemployment rate and the 12th lowest among US states. But the overall unemployment rate doesn't tell the full labor market story. In particular, it does not reflect Minnesotans who have left the labor force, including retirements or those staying home to care for children. Since the onset of the pandemic, Minnesota's labor force has fallen by 87,000. As of December, Minnesota's labor force participation rate was 67.7%, 2.5 percentage points lower than in February of 20. Nevertheless, the state's participation rate remains high relative to the United States, 5.8 percentage points above the US rate, and it is the sixth highest among US states. As with the US forecast, we do expect low unemployment and a high demand for workers in Minnesota to drive up total wage and salary income in the state. For another picture of the labor market, this chart shows total employment in Minnesota, so the line represents the number of people in jobs in the state, and it illustrates the state's steady job growth since the recession of 07-08. In March and April of last year, as the pandemic was taking hold, Minnesota lost 416,000 jobs, about 14% of February 20 employment. Since then, state employers have added jobs. Oh, and I misspoke. In March and April, not of last year, but of 2020. In March and April of 2020, as the pandemic was taking hold, Minnesota lost 416,000 jobs. Since then, state employers have added jobs in most months. Through December of 21, 307,000 of the jobs originally lost had been recovered. Minnesota employment is now 109,000, or 3.6% lower than in February of 20. Turning now to the revenue forecast, the first column of the table shows our current forecast for fiscal years 22 and 23, and the second column shows the forecast change. Since November, general fund receipts have exceeded our forecast. So the receipts coming in have exceeded our November forecast. Those higher tax receipts to date in fiscal year 22 and the improved outlook for income, consumer spending, and profits raised the revenue forecast for fiscal years 22 and 23. Total general fund revenues for the current biennium are now forecast to be $1.252 billion more than in the November forecast. We've raised the forecast for all major tax types. Individual income tax receipts are now forecast to be $498 million more than the prior forecast. The changes to the biennium are front-loaded. 70% of the increase occurs in fiscal year 22. Higher growth in wage and non-wage income, especially business income and capital gains in calendar year 21, raised the income tax forecast for the remainder of fiscal years 22 and 23. Sales tax revenue is now forecast to be $212 million more than the prior forecast. The increased forecast is consistent with the higher nominal consumer spending I mentioned earlier and is also due to higher than expected collections so far this fiscal year. The corporate tax is the same story. It is projected to generate $324 million more than the prior estimate based on the higher forecast for corporate profits that I mentioned and higher collections so far this fiscal year. So let me finish by reiterating some of the risks to this forecast. The assumption embedded in this forecast that inflation settles back into the 2% range next year depends on the resolution of supply chain blockages, higher labor force participation, and on the effectiveness of monetary policy to control inflation. However, bringing down inflation is made more challenging by the surge in energy prices following the Russian invasion of Ukraine. Higher energy prices drive up general price levels because energy is an input to the production and distribution of consumer goods. And higher or more persistent inflation can change the timing or magnitude of actions by the Federal Reserve and could slow economic growth below what is assumed in this forecast. But beyond price levels, additional impacts on the world and U.S. economies from the Russian invasion of Ukraine and subsequent sanctions against Russia pose some unknowable risks. As it has for the past 2 years, the economic forecast continues to depend on the path of the pandemic, including the impact of any newly emerging coronavirus variants or treatments. And finally, with 16 months remaining until the end of the 22-23 biennium, even small changes in assumed rates of growth in important income and revenue sources, such as capital gains income or wage income, can generate large changes in the outlook for this biennium and the next. I'll now turn it over to State Budget Director Ahna Minge.
Good afternoon, I'm Ahna Minge, State Budget Director with Minnesota Management and Budget. Today I'll be walking through changes on the spending side of the general fund budget. And this table really encapsulates all the changes we're seeing in the current biennium. As you can see, overall spending changes are relatively small, about 0.5% lower than in this biennium than in our November forecast. As you can see, E12 education, which is the largest area of spending in the general fund, is $158 million, or about 0.8% lower than our November projections. This change is due to several dynamics. First, the forecast reflects fewer than expected pupils in both the previous school year, sort of the 2020 through 2021 school year, and the current school year, which affects future projections. The forecast also reflects lower spending in special education transportation costs. This is because actual costs were lower in the previous school year as more special education students relied on remote or distance learning. In addition, the forecast incorporates lower spending on compensatory aid as a result of fewer applications for free and reduced price school lunch. This is primarily due to pandemic-related federal programs that provided free meals to students without the need to apply. Health and Human Services, the next line on the table, is forecast to be $108 million, or 0.7% below November estimates. The largest driver of this change is the extension of the federal public health emergency. As a result of federal legislation passed early in the pandemic, Minnesota receives a 6.2 percentage point increase in the federal Medicaid match for quarters in which there is a public health emergency related to COVID-19. In January of 2022, the federal government extended the emergency into April, allowing us to capture an additional quarter of federal match. The extension results in an additional $143 million in federal contributions for medical assistance. However, some of that is offset by increased costs to the state as a requirement to maintain continuous coverage for enrollees. On net, the extension is expected to save $65 million to the general fund. The forecast also reflects $40 million in savings due to lower use of the state's child care assistance program as a result of the pandemic. Caseloads are expected to return to pre-pandemic levels by the end of fiscal year 2023. You can see spending for property tax aids and credits is forecast to be $15 million, or about 0.4% lower than previous estimates. This is the result of fewer homestead credit refunds and renters' property tax refunds in the current year. Projected debt service costs are relatively unchanged, and then all other areas of the state budget combined had $12 million in higher spending compared to November estimates. In total, general fund spending in the current biennium is forecast to be $270 million lower than November estimates. However, the bulk of these changes are one-time, and the spending changes in the planning years are much smaller. And I'll turn it over to Commissioner Schowalter.
Thank you, Ahna. This last slide should look pretty familiar. It is the long-term budget outlook. And as mentioned earlier in the briefing, our revenue improvement was largely one-time, but not exclusively. What you see here is our projected revenues and spending for the current biennium as well as the next biennium, and comparing the two. So ongoing revenues, ongoing spending. The structural balance improves from about $5.6 billion in the current biennium to about $6.3 billion in the tails. Slight improvement from the previous forecast. What this does and doesn't reflect, though, is that 3 and 4 years out is certainly more uncertain than even what we're anticipating in terms of revenue and spending a year out. As I mentioned at the beginning, we're having a hard time sometimes understanding what's going to happen next month, much less 3 or 4 years from now. So this is clearly the most volatile and uncertain part of the forecast. The other element of this is also really familiar to you all, which is it doesn't include the estimated impact of inflation. The figure for the next biennium is a little over $1 billion based upon the assumptions in this forecast. So the spending does not include that effect while the revenues would. It does not also include the inflationary impact for the current biennium because, as you all know, we forecast on current law. And so our appropriations are set. That brings us to the close of this forecast. What we've seen here is that the state's economy continues to recover. There's been a lot of uncertainty, a lot of question marks that we've all worked through. As a community, we've dealt with those in the last couple of years. Although inflation continues to be a concern and the unfolding Russian invasion of Ukraine introduces new risk and uncertainties to our forecast, our budget outlook remains strong. This is due in large part to extraordinary efforts of parts of Minnesota workers and businesses. We've continued to adapt and thrive and find ways to continue working through this ongoing pandemic. I'd also like to thank the team at MMB and state agencies that prepared this forecast. We get to present it, but there's a lot of great professionals who are putting together this information in an uncertain time with uncertain prospects of what's going to happen next. Together, that forecast forms the document that you'll find online at MMB's website with all the detail, all the in-depth narrative that you would expect. In addition, you'll find information on fund balances for the Healthcare Access Fund and other separate non-general funds, the detailed information for the general fund, the debt capacity report, and other information. So with that, that is our February forecast. Really happy to present it to you today and open to take questions.
Commissioner, since you just mentioned it, and you know my traditional ask, what is the debt forecast?
The debt forecast really looks at the question of what is our state guidelines for debt capacity based upon our revenues and compares them on 3 different items. I should look up the exact numbers, but you can find it in there that the debt capacity on number 1 is different than the debt capacity on number 2, which is actually different than the debt capacity on number 3. The whole purpose is to really make sure that we have an affordable, sustainable debt portfolio for the state. And so we measure it in a couple of different ways. The most constraining of those are a little over $2 billion. Some of those figures are well over $3 billion.
Commissioner, could you speak to your estimate that much of this increase, I think you're saying, is one-time money? Because if you look at the numbers, wage growth continues, corporate profits continue, you've got a big surplus in the next biennium. So why are you thinking this is one time? And I assume you're cautioning budget writers to consider it as a one-time type increase.
Yeah, given my position, caution usually comes with part of where I sit. Looking at those uncertainties and trying to make sure we manage those risks. Fortunately, we have a lot of tools. We have the budget reserve, we have the cash flow account, we have good information We have a diverse economy. But that said, we're still trying to make sure that we look at it. In terms of one-time versus ongoing, a simple way of looking at it here is the structural balance. So you see here in 22 and 23, we've got about a $5.5 billion structural balance. So that's sort of the contribution of the bottom line in the current biennium. We have a $9 billion, more than a $9 billion surplus. The remainder is essentially one-time. So that's kind of the question of how much is one-time, how much is ongoing. Of how much is in the bank, about $4 billion is essentially in the bank. We had about $3 billion, $4 billion that we know of so far. We'll see how the rest of the biennium goes. And so that's where the uncertainty in this current biennium goes.
Commissioner, I think this may be for Dr. Kalambokidis. With the uncertainty factors, you've got a couple of them there, inflation and the geopolitical situation in the world. I think, folks, which do you think is potentially have more impact on this forecast? Do you have any way of knowing that? And then, of each of those two areas, I think inflation, folks pretty much understand how that would play out. But the geopolitical, what areas might that affect Minnesota specifically?
So what's interesting about this brand new set of risks is that they land on top of risks that we already had. So inflation was a risk in the November forecast. It's a risk now. And the reason, and even before the invasion, Russia's invasion of Ukraine, it was a risk because IHS is assuming that inflation does become subdued, that it does get back down in the course of our forecast horizon. And they were assuming that because they have looked carefully at the sources of supply chain blockages. They've looked carefully at labor force participation. They've looked carefully at where businesses and households anchor their expectations of inflation, and that they believe that the monetary policy is going to be effective. But if those things don't pan out, then inflation could be higher in the outlook than what we had. And then the largest risk, so the risk of that is, of course, that if inflation is higher, of course, everything costs more and households are paying more for goods and services, but also it means that the Fed might act more aggressively than what is assumed in this forecast, which raises interest rates sooner or higher than what is assumed, and that slows economic growth. So in that environment and on top of those risks, then we have an impossible to foresee impacts from the Russian invasion of Ukraine. The things that seem most obvious are that oil prices, which had already been rising because of the buildup of Russian weaponry along the Ukrainian border, oil prices being higher, which raises inflation in general. Commodity prices, in addition, can be higher. This is something that can more readily affect Minnesota, more specifically affect Minnesota, when Russia and Ukraine can no longer produce the agricultural output that they normally do, that can raise prices. That can raise prices for Minnesota producers of those same goods, although Russia and Ukraine are primarily producers of wheat, which we do produce, but it's not our main commodity. But it also increases inputs for food producers, for instance. So those are some of the impacts that we might see in Minnesota more directly. Of course, there are businesses that have direct connections to Russia and Ukraine, and they're having to mitigate risks. Of course, we have families and households who have family and friends in Ukraine. They're facing the hardship as well. But the other thing that can happen is that as the U.S. economic outlook, if the U.S. economic outlook gets revised down going forward, then that will affect generally growth in Minnesota, because Minnesota's economy, as diverse as it is closely tied to the U.S. economy.
Commissioner, given all these caveats that you and your team have laid out, how much faith do you put in this projection that you're putting out?
Great question. You're right. We do put out a couple of caveats here, and I still have a lot of faith in this. It is really difficult to issue a long-term forecast, even as the economy and the world continues to change. What we have is a snapshot that updates our information of what we know today. We're never able to answer all the questions of what's going to happen tomorrow. But I think we've dealt with a lot of those questions pretty successfully, and the state is in a strong budget position to continue making progress on all of the problems, all the questions, all the hangovers from the last few years, so that we can keep on moving forward with momentum. So I think this is a good piece of information. I think it's a important reference point. And as always, it requires judgment and constant diligence just to keep on updating, because there are a lot of things that continue to happen in the world.
Dr. Kalambokidis, can I just get back to what you were talking about? You mentioned wheat. I was thinking of wheat and sunflower and other commodities. Are there aspects of Minnesota's economy that are directly intertwined with Ukraine's and Russia's, or in other ways could get tied up in that conflict directly?
So Minnesota doesn't in aggregate have a lot of trade exposure to Russia or Ukraine. Our main trading partners are Canada, Mexico, and China. And I think that neither Russia nor Ukraine comes up into the top 10 of our trading partners. That is not to say that there aren't important Minnesota businesses that do have exposure in Russia and Ukraine, and they are mitigating those risks as we speak. One of the impacts that seems fairly obvious is higher agricultural commodity prices for those goods that Russia and Ukraine export. Wheat is one, sunflower oil is another. Minnesota produces both of those, and so those producers may see higher prices for their commodities. They may be incentivized to plant more, but those are not the major commodities that Minnesota produces, not even the major grains that Minnesota, or plant commodities that Minnesota produces. So indeed, there are businesses that are facing significant exposure, but in the aggregate as an economy, it's not an extraordinary amount of exposure.
Dr. Kalambokidis, right over here in the front. I was comparing the growth in the tax revenues that are collected from individual income tax, corporate franchise tax, and sales tax. There's some big differences between sales tax and individual tax and corporate ones. I think estimates of like 1.6, 1.7 for the first two, and then as high as almost 8% for corporate franchise tax collections. What accounts for those big differences between those categories there? Why are corporate tax collections so much higher than the other ones?
Yeah, the percentages that you cite are the forecast percentage changes. So it is how much those forecasts changed from November to now. And indeed, in percentage amounts, the individual income tax and the sales tax, the forecasts have increased less than the percentage increase in the corporate tax. The reason for that is that corporate profits, not just profits by Minnesota companies, but U.S. corporate profits is the driving variable behind what determines corporate receipts in Minnesota. And corporate profits are the most volatile income source. So the corporate tax is our most volatile revenue source. And corporate profits are highly volatile, meaning they move around a lot. And in the chart that I showed you, corporate profits have exceeded expectation for the last couple of years. And so that makes the corporate tax one of the hardest to forecast. So the forecast changes can be higher. I see the governor's here, so I think I'm.
Can I ask one question quick? About your slide on labor force participation, it showed that we're 3.6% below pre-pandemic in terms of labor force participation. But it also says in the text of the report that labor force participation rate does not reach pre-pandemic level in the forecast horizon. So those missing workers, the 109,000 or whatever, are they gone forever, never coming back?
So to be clear, the 3.6% is the percent that we're below our pre-pandemic employment level, not labor force participation. And so we are expected to reach the pre-pandemic employment level I think in a year, so a year following the US. So our employment recovery lags the US. Now, the statement in the book about labor force participation rate, so I'm delighted to pitch the book and all the information that's in there. That specific statement is about the US labor force participation rate. And what I said that IHS is assuming higher labor force participation at the US level, and that's one of the reasons they think inflation is going to come down. But they did lower their forecast of labor force participation between November and February. So they have brought it down so that it doesn't reach the US labor force participation rate doesn't reach the pre-pandemic level within our horizon.
I think obviously all the information is going to be available. We're happy to answer questions afterwards, but let's turn it over to the governor.